The cheapest growth stock to buy in the stock market right now. This is my favorite growth stock in the market. I talked about it many times and I'm going to talk about it again, as I personally believe it's presenting an amazing buying opportunity at this price. And whenever I'm looking at growth stocks in general, and I own many of them in my portfolio, I tend to want to ride a long-term tailwind, or I would call it a long-term megatrend. And you could maybe think of AI right now, how it's shaping the world. This is a long-term tailwind. You could think of the internet back in the 90s, early 2000s. A lot of companies like Amazon and many others, they got a massive boost in revenues just because they were at the right place at the right time. I want to be at the right place at the right time. And I also don't want to overpay for this opportunity. And I'm personally seeing an amazing long-term tailwind that I still believe is underlooked by the investors. A lot of people are shrugging it off. They tell me, yeah, whatever. Not a lot of people are really paying attention to the disruption that's happening in this sector. And this is mainly the healthcare sector in the United States, which is worth over $4.9 trillion. And it's being disrupted in real time for the first time ever by many different innovative companies. One of them, which is my favorite, is Hims & Hers Health. Hims & Hers Health is up 23% year to date, but it is down 23% over the last 6 months. It's a very volatile stock, down 63% from all-time high after just being up 200% in a few weeks. This is a very, very volatile company. I've been in the stock from $8 per share in 2023, and I always tell people, if you cannot take the volatility, then you shouldn't own Hims & Hers Health. But Hims & Hers Health is mainly, you could say, a telehealth company here in the United States. They have exposure to many different problems that a lot of people struggle with, including sexual health, dermatology, mental health, which is huge in the United States, and also weight loss. Over 100 million people in the US, they suffer from weight loss. And taking mental health as an example, a lot of younger people, they don't really want to go in person and talk to a specialist about all their problems and get the medication. Or a lot of people that may be living in rural areas, they don't have access to a lot of specialists, or maybe they have a full-time job and they don't have time to do all those things. They want something that's fast, easy, quick, something that's online. They can chat with a doctor and get their prescription delivered to their door. And this is what Hims & Hers Health accomplishes. Now, the biggest misconception that people have about Hims is that Hims is just a website. Anyone can create a website and compete with Hims & Hers, because Hims & Hers has no moat. They don't have any competitive advantage. They just sell on the internet whatever you can buy at CVS and Walgreens. It's the same kind of products that you can buy at Hims & Hers Health. And this couldn't be further from the truth. For example, whenever they were selling the GLP-1 compounded injections, a lot of people were using them not just because they're cheaper, but because Hims owns pharmacies. And those pharmacies, they modify the dosages to help reduce your side effects that you would experience with a regular, generic kind of drug. Let's say you experience, maybe you lose sleep at night because of Ozempic or whatever, and you tell that to Hims & Hers. Hims & Hers will adjust the dosage for you to help reduce your side effects. So it's not just a company that takes a product for $1 and they sell it for $2. They take the product for $1, they modify it, and then they sell it for $2 or $2.20. And this is what Hims & Hers Health is about. They have around a 47.5% market share in the United States based on how they measure it. I believe it's much, much less than that because they're competing with also Amazon. Also, Amazon does not have compounded pharmacies, but they're competing with a few players, and they believe they have 47.5% market share. Subscribers over 2.2 million, rapidly growing. There's so much TAM ahead for the company. Revenues growing 95% year on year. Massive growth for the company, over 81% gross margin. Very profitable business model. Now, my favorite chart from the latest earnings report is this chart about the amount of people that are repeat customers within Hims. Because whenever I'm owning a business like Hims, I worry that they're spending all this ad money for them to just be flushed down the toilet. Let's say, for example, they spend the ad money, they get you as a customer for your hair loss problem. And then once your hair loss problem is over, then you're gonna be gone. You're not gonna be using Hims forever. But I was kind of wrong about that, because a very decent percentage of those people are actually staying repeat customers within the Hims and Hers Health ecosystem, because maybe whenever they join Hims for, let's say, weight loss, Hims cross-sells them acne products, and they use the acne cream, or maybe mental health kind of products, or maybe other kind of things that people have, especially now they're expanding in testosterone, menopause with women, which both of them have launched, I believe, in 2025. And there's so many different reasons to remain in the Hims ecosystem and remain in Hims for pretty much forever, and refer the company to your friends and family. So it's a pretty amazing business model, much better than what I expected when I originally bought it. But looking at their own guidance for fiscal year 2025, they're expecting 56 to 63% revenue growth after having a record year in 2024, which is very impressive. 2.4 billion in revenues. Out of 2.4 billion, they expect 725 million in weight loss revenue. Now, many of you guys know that Hims was selling the compounded semaglutide GLP-1 kind of injections. And now the shortage is over, and very soon Hims will no longer be able to sell them. And this is baked in their guidance. So even with this baked in their guidance, they're still gonna grow 63%. And before GLP-1, Hims grew 95%, which is why I was trying to tell people that Hims isn't a GLP-1 company. But a lot of those people and a lot of those customers, they're transitioning to different products within the Hims and Hers Health ecosystem, such as the oral-based solutions. So instead of injecting yourself, you take 1 or 2 pills. They help reduce the appetite and lower blood sugar or whatever they do. And it's only $69 a month versus $165 for semaglutide, or over $500 a month for the Lilly kind of products, and NVO like $2,000 a month or something crazy. Many people, they can't afford it. So $69 a month. The oral pills are very popular within Hims and Hers Health. But they also have liraglutide, which has recently launched in 2025. And I believe right now they're selling it for $300 a month, which isn't really a lot. But again, I believe the oral pills is where a lot of the growth is happening within the Hims and Hers Health platform. Now, the main concerns that I get whenever I talk about Hims and Hers is that this is the next Teladoc. It's the same company. It's the same of everything. It's just the same industry. This is just the next Teladoc, and it's going to go down 95%. And I don't believe this is true, because if you look at Teladoc, Teladoc's average revenue per member is $1.39. Hims' average revenue per subscriber is $73. There's a massive difference between $1.39 and $73 per member. This is a massive, massive difference. And it's growing 38% year on year, because Hims is not within insurance. Hims has a much better, control around their costs, around their products. They're more vertically integrated. They can pass certain things, cross-sell certain things outside of the insurance system, which is much more profitable for Hims and Hers Health, and they intend to keep it this way. And this is how the company got more profitable over time. They were losing 53 cents in earnings per share. Now they're about to make $1.07 this year in 2025. Now, looking at the valuation, it's only trading at 2.8 times sales. This is dirt cheap for the company. If you compare it to other growth stocks in the market, I would say, SoFi, which I like very much, is trading at like 5 times sales. Stocks like Duolingo at 12 times. Palantir, forget about it. It's like 55 or 60 times. And for Hims, riding a massive tailwind, a massive megatrend of disrupting the healthcare industry, growing 63% in revenues at 2.8 times sales, this is dirt cheap for the company, and I really like it very, very much. Now, my favorite part about it all about this analysis is that what the analysts are actually expecting. And they're expecting HIMSS, after growing 93%, 65, 69, 57 this year, to only grow 16% in 2026. To me, this is funny. I just cannot imagine this happening. This is not Celsius. There's no inventories here. There's none of that stuff. HIMSS is expanding in so many different products, so many different sectors. I can't see HIMSS only growing 16%. It would be absolutely ridiculous in my opinion. But they had the same estimate for 2025. They had 16%, but the actual was 57%. And I believe the management, they're going to surprise the analyst again with this number. Now, for my valuation model, the way I did it is I took the current expected guidance of 2.3 billion for 2025, 2.3 billion. And over the next 10 years, I put in 20% revenue growth every single year for the next 10 years. Maybe a lot of you guys believe this is optimistic, or maybe it's on the high end, and it could be, I could be wrong on that. But based on my studies on the industries and on HIMSS and Hers Health, they should easily be able to grow revenues 20% a year. I mean, easy in my opinion. I would not be surprised if they even grow more than 20% a year for the next 10 years. As the company is still very small, it's still under 10 billion market cap, only 2.3 billion in sales. It's still early stages of the business cycle. The trend is still very early in disrupting the healthcare industry, and they're expanding and innovating very, very rapidly. There's a leader in the space. So I would not be surprised if they exceed 20%, and I think 20% is possible. Now, based on this 20%, I used 3 case scenarios: 3 times sales, which is the worst case, where it's trading at right now; 5 times sales, which is more likely; 7 to 10 times sales is like the high end of the range. Now, using 3 times sales for the next 10 years, I'm getting 550% on the upside. This is massive, massive upside for the company. And that's 3 times sales, which is insane. If you use 5 times sales, which I believe is more likely, the upside is around 1,000% for HIMSS and Hers Health. If we get to 7 times sales, which I wouldn't be surprised because the company will be more profitable over time, they would have more recurring revenue through the data business, which they're developing, and other home testing stuff and anti-aging kind of products they're developing. It's going to be insane for the company. And I call it the Amazon of healthcare in general. And a lot of people, they're not looking up to that stuff. But at 7 times sales, it's 1,450% on the upside from today's price, which is amazing upside on the company. And the question is, what if we're wrong? What if it doesn't play out? What if, something bad happens? And I always tend to tell people in general is with growth stocks, if you write on HIMSS, for example, if you write on HIMSS and it goes up 10, 20, 30, 40 times, then you don't need to put in a lot of money to make a lot of money with HIMSS. But if it doesn't work out, then you don't lose too much. All I did in 2023 is I put in a small percentage of my portfolio at $8 per share, and then I bought more at $5.55 per share. And I just held, and I averaged up at 11, I averaged up at 21, and I kept it a small percentage. Most of my position now is gains through the stock going up. And if I'm right, HIMSS is going to make me a lot of money. But if I'm wrong, then I'm not going to lose too much because I have the best risk-reward setup within my own position sizing in my portfolio. And this is something a lot of people, they don't think of. They spend way too much time on analyzing the stock and way too little time spending it on assessing the risk-to-reward setup and how they assess position sizing within their overall portfolio. And this is something that I share in my own group. This is the link if you're interested. And that's all I have for today. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.